Bill, as we talk about the general sense of positivity, near record highs for our markets, a general sense of an upswing for many parts of the world, does this mean that the markets can take another leg higher?
I think they can. Sentiment isn't overly bullish. It's got moved a bit this way. I think, we'd all say there's certainly a lot of doubters out there. The other thing that I watch is the amount of money market assets, and we hit new record highs in the amount of money market assets out there too. So there is plenty of fuel there. Certainly, it's I guess a tug of war between some of the slowing economic data versus global central banks, and we'll see who wins.
So among that environment with global central banks, they are dealing at this point with the idea that there's a slowdown in the economy, perhaps not recessionary, but global purchasing manager indices, many measures of service industries are all showing some signs of perhaps slowing down. Take us through how that sets markets up at this stage. Are they all dependent on central bank intervention because of these slowing PMI levels that we're seeing all around the world?
I'd say they're a bit more, or at least we'll focus on the U.S. a bit, certainly a bit more dependent on the central bank, because I think you wouldn't necessarily see the market, as you mentioned, pretty much at highs with this kind of setup in terms of a slowing economy, unless you thought that the Fed was going to reflate it again, or the global central banks were going to help reflate it again. I think that's, I'd say, both the risk and the reward. But the interesting part is, when you look back at history, there's a good reason for the market to think that, because historically, when you've had the Fed easing rates, lowering rates at a time when you haven't had a recession, the market has, in fact, done very well. So if it plays out as at least the market seems to be sniffing out, we probably do have more upside here.
So we've got big comments and meetings coming up from the European Central Bank and the Fed as well. Is there anything that can be set? So first of all, the expectations are there will be a general easing bias. But is there any kind of an expectation that things could go wrong if they say the wrong thing? What exactly could be the downside? What do these central bankers have to avoid doing to scare the markets?
Well, I think at least particularly in the U.S., they have to be careful not to, I guess, allow expectations to get too far or too many cuts, because the danger is you're walking this kind of tightrope between, if you signal too many cuts, the market starts to say, oh, this thing's really going downhill. We actually are going to go into recession. There's no one that can save it. And then I think you see the market really have a difficulty. If you walk the line of 2 to 3 cuts here, and it's these quote unquote insurance cuts, it's okay. So I think that's why you've seen at times the Fed trying to, and they did it last week, in fact, walk back, getting too exuberant around the number of cuts. And I think that's a positive. The ECB is a little tougher. I think for sure on Thursday, they're going to signal that they're going to do further easing, or I should say at least signal. Draghi does like to surprise people, so I'm keeping myself ready that maybe they do just pull the trigger on Thursday and do some easing. But easing's coming. You see it from the data in Europe. They already announced that if things don't get better, they'd ease. And I think, with where their data's at, they're going to ease. If it's not this time, then September.